What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is December 13th of 2018. Well, folks, I hope you all are having a wonderful day wherever you are, and today we've got a wide range of topics to discuss here on the Daily Update. First, we're going to be talking about cryptocurrency markets, where we discuss some positive news out of Germany, where the second largest exchange in the country has now launched a zero-fee trading platform for cryptocurrencies and plans to expand into a wide range of different crypto projects. Along with that as well, we've got some sad news coming out of the stablecoin market, where a stablecoin project was recently canceled due to concerns mostly with the SEC. And along with that as well, we've got some news that we need to talk about in regards to the European Central Bank and the importance of following and tracking the monetary policy that's going on in the Eurozone. So we've got lots of things to talk about. Let's not push it off any longer and dive right in to the update. Our sponsor for this video is Energy. Energy is a scalable, self-funding masternode cryptocurrency with the goal of becoming the world's leading crypto platform. Energy is the cryptocurrency designed to employ 1 million people, leveraging the largest and most powerful treasury system in the space, all with no ICO and no pre-mine. Alright, so let's go ahead and spend some time to talk about market valuations in crypto. Obviously, because Bitcoin is almost down 2% over the past 24 hours, even though it's not serious price movement, it is having a dragging effect on the overall broader market. We can see that there's a few players in the green here. However, the mass majority are in the red. Luckily, not too extensive off of Bitcoin's price action for the most part. And really the ones that are depleting here are players like Factum, Bitcoin SV, players that have actually done quite well over the past few weeks during the sell-off. So it's actually nice to see that most altcoins are actually not losing that much compared to Bitcoin. We're starting to see, I think, that risk spread between altcoins and Bitcoin, or not so much the risk spread, the reward spread and the loss spread, really it's starting to mitigate. It's starting to get much more narrow compared to what it was, say, back a few weeks or months ago. But going on here, guys, I'm not doubting the reality that I think we're still going to probably see 3,000. Again, you guys get to determine for yourself if that's the case. And I'm not claiming that it's going to be the official bottom here for cryptocurrency markets. Again, we've gotten into the danger zone, the twilight zone, where things just keep getting crazier and crazier. However, it is nice to see that over the past 30 days, we can see an obvious trend here where sell-side momentum has slowed down. I think more than anything is that we're not only going to see 3,000 retested because we're very close to it on most major exchanges, again, avoiding that Bitfinex premium. But along with that as well, I think we're very close as well to testing a very key level, which is $100 billion in valuation for cryptocurrency markets. And right now, the lowest level we've seen in the past few weeks was here on December 7th at $104 billion. And we're only $4 billion up from that. We're at around $108 billion. So another $8 billion correction in these markets would really not be that hard to find. Not to mention we have reached relatively low volatility, so I think we could see a spike up here in the next few days, as we'll take a look at. And I'll explain how on Bitcoin, more than anything, we're starting to see a continued repeat on the 4-hour, or really on the hourly. It doesn't really matter how you look at it in regards to price action. That would tell us that we're probably going to see 3,000. But again, I'll explain that in just a moment. And again, as we see Bitcoin dominance rising up here over the past few weeks, really throughout the end of November and December, it looks like we're very well on our way to retesting up here at near 57%, seeing as we're a little bit below 55% at the moment. If we get one last final flush to 3K, I think that's going to have a pretty damaging effect on altcoins, at least just in the short term, and it's going to cause a little bit of panic selling across the board. But going on here, let's go ahead and spend some time to talk about current price action. So the big thing to keep in mind is this weighing downtrend line here. Again, you want to get a break on this if you want to start to turn bullish, but I really honestly don't think we're going to see it just yet. The reason being is because we're seeing a repeat in technical patterns here from what we saw back between the end of November to early December. So what do I mean by this? So at the moment, we're taking a look at the 4-hour chart on Bitcoin. We can see almost a rising head and shoulder pattern here, where there was rising lows, and you can see the pattern where you have the first shoulder, the head, second shoulder, and then a continued decline in price, especially when we started to turn over and hit resistance at what became support up here. And then would continue to decline, of course, as always, from 4,000 down to 3,400. Well, in this case, it looks like we're having a miniature version of that being built up here. We can see the first shoulder here, the first head, and the next shoulder. And with the rejection here, again, at some of the moving averages, now, of course, we're taking a look at the 4-hour. But if we take a look at the hourly here, Again, still tossing up with the moving averages, no serious breakaway, and still providing a decent amount of room where we need to not only get an up bump to 3,700 if we plan to really break resistance, but we need more fuel than that in order to break past this and really start testing some of the longer term downtrend lines, in this case, the one that was basically holding price down up here. You're going to want to hope more than anything that Bitcoin gets above here, hits resistance, and really starts to, build up in this channel, escaping the lower band of price action, and then eventually breaks up to test the 200-day. It's going to be a stepping process, guys. This isn't going to happen overnight. Don't feel like you're going to miss the bandwagon. You can see here that the order books are quite heavy right now. This is, of course, just Bitfinex at the moment, but I can tell you across the board, the sell side is still pretty well built. There's a lot of buyers down at these levels, but it seems like a lot of sellers are going on market, doing market orders, and really clearing through the order book of any buy orders. Then again, if we get down to this range as well as towards 3,000, I think you're going to start to see a lot of these candles, as we've seen a lot of the 6 to 10,000 Bitcoin buy orders on spot market. And I think more than anything, that's a good sign, but it's not exactly clear as to whether or not we're going to reach a full bottom. So I don't want to assure you guys of anything. More than anything, all I'm noticing in the short term is the technical patterns I see, and very well that we could roll over and test the big even of 3,000. I think it's very likely to see that at this point, seeing as we've gone down this much. So again, as everything is generally tracking Bitcoin right now, until we get a serious sign of a rebound or confidence that in the next day or so we're going to see a rebound, we're going to skip out on altcoins at the moment. But across the board, guys, most are generally following Bitcoin at the moment. Alrighty, so let's go ahead. Let's talk about some good fundamental news coming through in regards to cryptocurrency markets. So Germany's second largest stock exchange is launching a zero-fee cryptocurrency exchange. So this is kind of the first entry point for one of the major institutional exchanges to actually offer a real, crypto platform to trade. Not to mention it is zero fee, which is nice, but there is some restrictions and it is still in development. It's not exactly ready just yet. However, I'm not going to try to pronounce it. This is the name of the exchange here. I think I looked it up. Okay, I'll try it. It was like Stuttgart. I don't know. I'm not good at German. Maybe we've got a German viewer here who might be able to critique me. But anyways, this is the second largest exchange in Germany, which on the global stage is a pretty well-established market. And along with that as well, they actually talk really not only about how this has been in the news for a while. This has been announced all the way back in May, but the fact that they're actually starting to get the infrastructure built out, that this is actually becoming something that's looking like it can become a reality rather than just, 1 or 2 years we're going to get this built. It looks like they're actually getting this built and actually launching it. Down here as well, I really like the quote here that kind of sticks to their vision more than anything in regards to what they're trying to build. And I think as well, if people are in the traditional financial system, I think they would benefit very well with this kind of mindset. And the same goes for us in crypto, where we kind of, again, have that black and white view of, oh no, we can't trust the traditional financial system, or, the other systems like, we can't trust crypto. It's money laundering and, it's criminal activity in the Silk Road and things of that sort. I really like this quote here. A reliable and efficient trading platform is an elementary contribution to their vision of a hybrid financial world with both fiat and cryptocurrencies. This is the world that is going to be the future, guys. I know a lot of us believe tomorrow something's going to happen and everyone's just going to switch to crypto. And some people believe that cryptocurrencies will never be a thing. But if you understand the fundamentals of cryptocurrencies, you understand that in the sense, like fiat currencies, they are digital money, but they're separate in the sense that they are immutable in many cases, that they are censorship resistant, and they have fixed monetary policy to a decent degree where you're not having to worry like a central bank who can manage interest rates and the quantity of supply, just like with the snap of a finger if they believe it's good for the underlying economy or the currency itself. This is where we can find that beautiful hybrid where there will be fiat currencies in the world. So long as those fiat currencies don't die, there will be fiat currencies. It's a technology that until it really gets sunk into everyone that they have some pretty big flaws, people are going to continue to use them, especially the stronger ones like the dollar and the euro. But we're also going to have a market where there's cryptocurrencies as well. Things like Bitcoin, Litecoin. I think any kind of peer-to-peer digital currency you can think of, even privacy coins. They're going to build systems that allow for trading of this. Now, again, as they stated in the quote, this is an elementary contribution. It's a first step. It's nothing big. For example, The exchange will offer protection for up to 100,000 euros in regards to the German regulatory bodies to start trading crypto. This is not nearly enough for larger established traders and investors. Not to mention as well, we don't know the degree of what custodial solutions they're using or what they're going to be offering in regards to the range of coins and tokens you can trade. But it is nice, at least they're covering the major portions of it. For example, they're going to have options trading for both Bitcoin and Ethereum, and also we'll be launching a variety of hopeful ICOs. Again, I'm not as excited for this. I'm more happy that they've got Bitcoin and Ether, and I hope they list more peer-to-peer digital currencies. I think that's the safest, best first step. But it is good to see that they are open up to potentially launching some of the other tokens and other platforms. More than anything, though, I hope they list legitimate projects. And, actually, as you all know, I worked with Unibright as an advisor, and I do know that the German government's actually quite open. I know Merkel, for example, had a quite negative view on cryptocurrencies, but overall, the German government has actually been quite handy in the sense of kind of starting out of this new market, because Unibright was a new project that did an ICO, and we fit under a utility model, and the German government actually sat down and spent the time, because we were compliant with regulators, actually sit down and provide us a framework to let us know, are we launching a security here, are we launching a utility token? So again, just want to show that as a sign of relevance to the fact that they are pushing forward in the German government. It's good to see, again, I'm not going to try to pronounce that name, that the second largest German exchange is actually offering something like this. Definitely set some competition for a lot of exchanges out there that charge ridiculous fees. I'll just leave it at that. I won't name names. Anyways, going on here, let's go ahead and talk about some sad news, but also a little bit of explanation with it. As we all know, outside of security tokens, all the rage is in stablecoins for two reasons. A, because they're really offering a new unique path to bringing fiat currency onto cryptocurrency exchanges, and B, stablecoins are all the rage because while crypto's going down, stablecoins are stable. People like that. But going on, I want to spend some time to talk about Basis. This was one of the stablecoin projects I'd heard a little bit about a while ago, but it definitely has still kept under the radar, as many of these have, until they really launch and start to blow up and start trading on exchanges. But Basis was a relatively interesting cryptocurrency a crypto stablecoin in this case. They wanted to provide, more than anything, very similar to, I think, what you kind of get from Gemini and a lot of other exchanges, a peer-to-peer digital dollar that could be used and transmitted across the world. All you really needed was an internet connection, as they kind of stayed on their website. But I really wanted to point out here why I think more than anything that they had to pull back the funding. They had raised over $133 million from big names like Bain Capital Ventures and Andreessen Horowitz. But the major thing that they had to admit to, even though they had some really cool technology using algorithmic stablecoins, this is kind of one of the major methods that people use using algorithms. The major thing was that there was a secondary token that had to be generated when you would be creating this currency, and it would be known as a bond token. So much like in traditional currency markets, I think you can kind of see the similarities, which you would need to purchase in order to, for the primary token to be kept in a stable peg in place. So the whole utility of the coin depended on this secondary bond token. In many cases, the secondary share bond tokens are seen as securities under U.S. law, Freeman told Cointelegraph, implying that the regulatory headwinds allegedly behind Basis's decision to shut down comes from the U.S. Securities and Exchange Commission. So it's not so much that their concept couldn't work. A lot of stable coins have a lot of pros, and then they have that one con that they're like, oh, we hope this doesn't happen. I don't really know in this case, the only worry here that they had more than anything is that, A, it was a worry of regulatory approval in this case with the SEC or being penalized for doing this. But also as well, they were worrying as well if people, it was basically a matter of if there wasn't a consistent liquidity coming through as well, much like a lot of other stable coins, if people would stop buying it, then in that case, you wouldn't have the stable valuation as well. They talk about it a little bit throughout the article, but I'm more than interested in anything in the sense of what I highlighted, and that is the regulatory framework that the SEC is setting up. And again, it proves more than anything. I'm not saying that the SEC isn't trying to work to allow cryptocurrencies to expand. I think more than anything, they'd like to help build a replacement to Tether. I think as a regulator who was kind of slow to the curb, They should be working 24/7 with a specific division within the SEC that's focused on cryptocurrencies to making sure we can get these stable coins on the market. Okay, I really do believe this is kind of a necessity. And if we don't, we're going to have more tethers. We're going to have more fraudulent ICOs. It's about building a framework that builds a higher standard and supporting those projects that are setting a higher standard for not only regulatory agencies, but also for users and the assurance of investors. So I don't like seeing that this is what's setting them back, but at the same time, hopefully the SEC will correct its framework and allow them to do more things down this alleyway. And I think, honestly, building a bond token, it's not so much of a worry here. But then again, they are worried, I guess, in the sense of potentially launching a security. And it's good that they're playing it safe more than anything. What's nice as well, unlike a lot of projects, they're returning their funding, or at least the vast majority of it. So that's good to see. All right, so let's go ahead here. Let's talk about the ECB. So the European Central Bank is looking to the end of QE in a time of risks tilted to the downside. So I want to spend some time to discuss not only my general view on the European Central Bank, but really put into some perspective the current state that the European Central Bank is in. This is really what is seen as probably the second largest central bank on the planet, as the Eurozone is quite a powerful force to be reckoned with on the world stage. To be fair, more than anything, guys, I do hold a generally bearish view on the ECB. And the reason being is that whereas, for example, the US is steadfast towards potentially 3% interest rates here going into 2019, 3% or above in regards to the Fed funds rate, and has already ended quantitative easing, the ECB has determined that this is the year that they are going to finally cut off buying assets. So they're just exiting out of quantitative easing. And not to mention with that as well, as we'll talk about later on, you will see just how ridiculously low interest rates are in the Eurozone. Okay, and this is still at a time where the European economy is already starting to slow, and we've got some weak links. We've still not seen major improvements with Greece. Italy is in the crosshairs right now. There's protests in France, for example. You've got a whole plethora, not to mention, some toss-up in regards to Brexit at the moment. You've got a whole plethora of different things going on, and generally, the Eurozone of the world. But basically going on, I want to spend some time to talk more than anything about the rates here. And the very low rate, the very low rate, no pun intended, the very low pace in which the European Central Bank is looking to raise rates. So going in through 2018 to 2019, they're looking to see more than anything at the moment. We've already seen here, this is saying at the current moment that we've seen a rise in rates of a few basis points here. Now, bear in mind, I want to provide some perspective who might not know what basis points are in financial markets. Basically speaking, 25 basis points is a quarter of a percentage. So 100 basis points would equal 1 percentage point. This means that at the moment, the Eurozone has risen through 2018 and 2019, roughly around 25. In this case, I'd probably say it's 14, so 39, to 5 extra basis points, which is 44. Sorry, I don't know why I was checking on my math there. So 44 basis points, almost half a percentage. And again, this is, according to the chart here, it says it's the current rate. And then they also have expectations going into 2020, if I'm reading this right, that they're going to add another 25 basis points, another nearly around 27 basis points, and hopefully somewhere around 33 to 34 more basis points. And if this is the rate, the rate at which they're rising, I think it's not that bad. But to think that in 2018 and 2019, where the Fed is already on pace in the United States to reach 3% or higher during this time frame in 2019, it is amazing to see just how slow the European Central Bank is taking their rises on monetary policy of rates. And the reason why this is so shocking to me, as I was mentioning earlier, as we talked about, the European Central Bank does not have a 1 or 2 or 3% interest rate. No, the actual European Central Bank, or the refinancing rate of the European Central Bank, is 0%. Okay, it is 0%. Now, maybe for example, as we're looking at this chart here, it's saying that there's a few basis point increases. Yeah, sometimes you get that. It fluctuates a little bit without making a major announcement like a 25 or 50 point basis increase. But to be fair, guys, the current data that I'm looking at from a variety of sources is telling me that it's 0%, and it hasn't seen a rate rise since back in 2016. In fact, some are reading that it's negative. So I really want to emphasize why this is scary, because it might seem like a good idea. In this case, if there's 0% interest, then money's cheap and it'll help stimulate the economy. But it proves a point of weakness when the European Central Bank literally for 10 years had to indulge in quantitative easing and practically drop interest rates not only down to 1% for a large period of time, but also continued to decline it until 2016, where it reached 0%. Why is this a sign of weakness? Well, let's go ahead and talk about two things. Quantitative easing. Quantitative easing was basically buying off bad assets off the books of a variety of commercial banks in the Eurozone as well as in the United States where they did QE. And along with that as well, purchasing treasuries and all types of different financial products that, again, help provide relief to the economy, quantitative easing. And in this case, they have gone through ending that program, whereas the U.S. again has started to do quantitative tightening. They've started to empty off their balance sheet. They've started to rise rates, and U.S. markets are still holding quite strong. Whereas in the Eurozone and European economy, generally speaking, you can see that equities and not only that, but the underlying economy have started to deplete, even as rates are at 0%. Now, they are starting to end quantitative easing, and that's a good first step. It's exactly like it was, generally speaking, in the United States. But there's something we need to talk about, and that is the fact that the rate of borrowing capital from the European Central Bank is still 0. And what that generally means is that if I can go and borrow, let's say I'm a big bank or I'm a wealthy businessman of some sort, and I want to go out and borrow $10 million from the European Central Bank, that means that I need to do one of two things. A, I can go out and find some fixed income market, something that guarantees me income. And again, people were doing this with treasuries initially in the United States after the Fed had lowered rates to 0%. I can go find some fixed income markets that are higher in the sense of interest that I gain than what I would be paying to the central bank, which, oh, look at that, not very competitive, 0%. Or B, I go gamble in assets where I might be able to make 4% or 6% or 8% without any interest payments to the bank. Man, that's a really fun deal. I just got to pay back the principal. Just got to make sure I don't lose out on the principal. Well, that allows a lot of people to take some crazy levels of risk. And even with the ability to do that, to practically borrow capital for free, just to make sure that you pay back the principal later on. The European economy is still struggling. It really doesn't make much sense. Even during this time period where capital is virtually free to borrow. Of course, again, I don't mean to say it's free in the sense that you don't have to pay it back. You do. But you don't have any interest payments on it. Like when you go out for a mortgage or you borrow credit on a card, you might be paying for a mortgage 4 to 6%. For a credit card, you might be paying 15, 20%, depending on your credit rating and what kind of card you have. Again, very, very different world for, I would say more than anything, the big club, more than anything, the club of bankers and financiers. They get the 0% interest rate from the central bank, and they get to prop it up into assets. They get to use it to buy up stock and homes. And this is why, again, why it seems like not only the stock market has just been rallying, but why you can't afford housing, why you can't afford living standards, things that you expect. Why invest in the real economy when you've got plant and factory equipment that you got to pay for and employees who expect some kind of wage? Now, screw that. We're just going to invest it in some false asset market. That's exactly what's been going on in the Eurozone. And even the European markets can't keep up with this. So it shows us when money is virtually free, something very, very wrong is going on. And just imagine a world where the European Central Bank, if they do follow on course, bear in mind, if they do follow on course with this, they are going to be nearing 1%, if not a little bit more. What happens when the Eurozone potentially reaches between 2020 to 2021, 1% or 2%? Let's really think about it here. What will that mean for the European economy? And what will it mean for global markets? By that time, the Fed will be at 3% or higher. It's supposedly according to its rate pattern or its rising of rates. And other markets as well are probably going to be following suit in order to keep competitive in monetary policy for the underlying currency. It's a very, very nasty situation, guys. I can't tell you all. Again, the biggest focus here, more than anything, when I look at as a macro trader and investor, I scan markets as a whole, and I try to get a good assessment of, are we on a risk on or risk off period? We are definitely making a transition to a risk off period. It's becoming very clear that assets are not in an optimal position, because when monetary policy is tightening, that's when you start to turn the opposite direction. That's when the punch bowl has tipped over, in a sense. The party's over. And the reason I say that, and why I was a bull for so many years, through really almost most of the past decade except for 2018, when I got into trading and investing, I knew that monetary policy, more than anything, was fitting into the place where assets were going to keep rising. It was very clear. It's not that difficult. If you understand the basic mechanics of it, how it distorts markets, then you understand you can keep investing in assets. You can keep taking risk, because that's the only incentive model there is. But now markets are not incentivizing risk. They're incentivizing safety. They're incentivizing cash. They're incentivizing you get the hell out of assets, to put it lightly. Okay, not so lightly, but anyways, I've rambled on enough, guys. Got my point across. I think you guys know a lot of this already, but I thought I'd share it, and it would be interesting just to, again, to keep an eye on the European Central Bank, keep an eye on some of the major banks across the world, and see how they differ. Again, they might be ending QE, and their capital might be cheap even though they're ending QE. But again, as we talked about, that capital can flow into other markets. That's the crazy thing. Might be going to the United States, might be going into Asia. So as they provide this free capital, might not be going so much into European markets, which could explain a lot of the lack of growth, even in asset markets for European markets. All right, so rambled on about that enough. Let's go ahead and spend some time to take a look at the Qs. Now we are looking again ahead of the market open. At the moment, it's currently 7:50 when I'm at this point of recording, but want to talk a little bit. I was reading a Bloomberg article. You guys know I do like Bloomberg, but it was really funny. I saw this headline from Bloomberg, like another major news source, that stocks came roaring back the other day. And it's like, yes, the market, for the past 2 days has been moving higher, but every single time it fades off and loses the majority of its gains. So if we take a look here on the hourly, we can just see every time it pops up, it gaps up in the market. You just have a fade every single time into the close and throughout most of the day. So this is really not a good sign to see. More than anything, I'm still open to the idea that we could come back up here and retest the highs again. But boy, oh boy, I'd actually like to see that, because if it comes up here and gets a rejection around the 200-day or this line of resistance here, I think it's very likely it's going to hit one of those two if it does test that region. Boy, you've got some things to get past. You've got a lot of factors here in regards to TA that are going to hold back this price. And this isn't good to see, as we've been seeing lowering lows. Now, it is a good sign here. I will give it this, that we saw a higher low here comparative to over here back during, I think this was back in November. Sorry, my coffee cup was getting in the way. But again, speaking here, guys, the only way I'm going to turn bullish in the short term is if the major indices, again, the NASDAQ has a sloping effect here, but it goes with the S&P 500 as well. As we can see here, the line of resistance was generally on 2,800 points. I'm going to need to see equity prices get above that point of resistance and make support out of it. That's the only way I'm going to turn bullish in equities. And from there, if that's the case, I think what we're going to see is a head and shoulders pattern. So we really won't have that much room to go. I think we're going to stop out here a little bit on the higher end of, the S&P 500 here, for example, maybe 100 points higher from where we would possibly turn bullish in that case. So there's really not that much room. The risk you're going to be taking probably is down here. Probably most people wouldn't be waiting if they really think that equities are going to bounce up and continue that pattern. But I really don't like the feeling of this, guys. This is not good to see us hovering down in the same volatile region that we had back here in early 2018. And as we talked about as well yesterday in the VIX, really recommend you guys watch the video I had talking about the divergence between the VIX moving averages. I'll go ahead, pull that up on the monthly here, just to show you guys again, if you guys want to set it up for yourself, and you want to high the base underlying price. Sorry, it's messing up my lines here, but actually no, we can. It's the fact that I have to pull up the S&P 500, and then you want to go here to compare, type in SPX, and there we go. This is it right here. So basically, again, talking about the divergence, I'm still not adjusting to it for some reason. I think it shrunk my lines, but again, talking more than anything about the difference between the 50-month here and the S&P 500 on the VIX. And it can show us, again, we are having a very clear sign of reversal. So anyways, let's go ahead, spend some time talking about gold here. I want to spend some time. We'll go ahead and turn off the moving averages and go down to the daily. We'll go ahead and turn that off. Sorry. I don't know why I wanted to show it to you guys. If you guys haven't, I recommend go and watch the end of the last daily update, and that kind of explains it a little bit more. But anyways, going on here with gold. Gold and silver are finally starting to pick up pace, guys. This is clearly becoming an uptrend here. And again, what I like is that we've built a third higher base here as we've been continuing since 2016, even with the sharp correction we had over the past few months. However, I do like to see this more than anything, though, because of a few factors. Like I've mentioned, the gold and silver ratio. Silver is cheap comparative to gold. But along with that as well, silver has a better chart, in my opinion. I'm keeping a very, very sharp eye on silver at these levels. So we can see, again, holding historical support around 14 to 14.20 here per ounce. This has been a level we needed to see silver hold, and at the moment it's currently holding. It's a matter of breaking resistance. I think more than anything, a serious close above $15 is going to lead in a renounding uptrend here. Now, we have to be patient. We have to see if that's going to happen. Right now, we're still hitting resistance at 14.80, big even level here. Again, these 20-cent moves are going to be big deals for silver over the next few days. If we can close above $15, moving up another 30 cents here per ounce, I think you're very well going to be passing any serious resistance where you could start to see some serious upside in silver. Now, again, I'm not recommending you guys to invest anything. You gotta determine that for yourself. I'm just keeping an eye on it as a commodity. It interests me at these levels. And along with that as well, as we've been talking about, we've got URA still building up in the technical pattern, guys. We are getting towards the end of December and or towards the beginning of January very soon here over the next few weeks. And with that, I think we are finally going to see in Q1 of 2019, very likely, that we are going to see a breakout on this. Now, again, keep patient, wait for the close above it, wait for the momentum and the volume to arrive. If you do want to trade it, again, you're going to have to determine for yourself if you guys see what I see on it. It's not financial advice, but this is something that I've been watching about for a long time. You guys know I've rambled on about it. I'm getting very, very eager for it, but I've not entered into a trade yet, as I will let you all know when I do. Anyways, that's it for the video, guys. Thank you so much for listening to me ramble today. I hope you guys have a fantastic day wherever you are. And if there's anything we didn't cover in the video, please leave it down in the comments down below. Anything interesting that you think would catch my eye, definitely leave it down in the comments down below. Get a discussion going. But until the next video, everyone, thank you all so much for watching, and I'll see you all in the next one. Stay tuned.